All right. Good morning, everyone. So, I've been talking with people since the midterm, in office hours and after class, and one thing that I found kept coming up was the question of how is it that monetary policy works? We understand that there are various shocks that affect the macroeconomy, and the Fed has the job of trying to deal with them using monetary policy. But the question is, how does monetary policy actually work? And I decided that the reason why this question kept coming up is because monetary policy actually works in many different ways. So there is no one answer to the question, how is it that monetary policy works? There may be some disagreements among macroeconomists about which are the most powerful ways in which monetary policy might work, but the point is there are many ways. And so I thought, as a result, that it would be useful to go over some of these ways one by one. And these are things that came up at different points in time in different classes. These are things that came up at different points in time in different classes. But I think maybe the best way to clarify everything is to just talk about them one by one in order. And so we'll have a comprehensive view of how it is that monetary policy might work. So the way this is phrased in macroeconomics textbooks, including ours, I think towards the end of chapter 14, is transmission mechanisms of monetary policy. So, transmission mechanisms of monetary policy is a fancy way of saying how is it that monetary policy works. Okay? So that's what we'll talk about today. And as we'll see, there are lots of different ways in which monetary policy might work, but we're going to see that there are sort of 4 categories of transmission mechanisms of monetary policy that we're going to come across that all have something in common. So you'll remember, of course, that when we started talking about monetary policy, I asked the class, so when I say monetary policy, what's the first thing you think of? Or when you read about monetary policy, what is it that, when you read that the Fed has changed something about their monetary policy, what is it that they changed? And of course, the answer is interest rates. So one category of transition mechanisms of monetary policy is going to be interest rate effects. Sometimes, macroeconomists have their own language. So just as, how does the Fed do monetary policy? How does monetary policy impact the economy is often phrased as transmission mechanisms of monetary policy. Similarly, these effects that we're going to look at are often referred to as channels. So when you're reading the textbook, you'll see him talking about mechanisms and channels, and they're just talking about how monetary policy works in this fancy language. So the first effect of monetary policy on spending is what I guess I'm going to call the traditional interest rate effect. And the idea of this is how I guess typically people think about interest rates. And actually, just to simplify our discussion, of course the Fed sometimes wants to lower interest rates to stimulate the economy. Sometimes they want to raise interest rates to slow inflation. To make our discussion simpler, why don't we just pick one and stick with it? So let's assume that we're thinking about the case where the Fed is trying to stimulate spending. In other words, we would be looking at a case where the Fed is trying to lower rates, right? So the traditional interest rate effect is that we're assuming that the Fed has some control over interest rates. In the case that they're trying to stimulate spending, the Fed would be making interest rates lower. And how is that going to affect the macroeconomy? Well, a lower interest rate means borrowing is cheaper. And how does that end up affecting spending? Well, to the extent that consumption and investment are funded by borrowing, this stimulates consumption and investment, and thus increases spending over what it would have been. Next, of course, I have just written this out assuming that the Fed can lower interest rates. So I just want to spend a couple of minutes reminding you how it is that the Fed can actually do that. And there are actually several different ways of looking at it. So I'm going to give you two. And they're not mutually exclusive, right? The Fed is doing all of these things at once. This multiplicity of effects is the whole reason why we're having this talk today. So you'll remember, of course, that when the Fed is lowering interest rates, they must be doing so by buying assets. The question is, how does that then go on and influence interest rates? There are, as I said, several ways in which they do that. But the key thing is that to buy securities, assets more broadly, the Fed must pay for them. And of course, whenever the Fed pays for something, it's either paying it by issuing new cash into the world, or it's paying for it by just adding more reserves into the seller's reserve account. And so anytime the Fed is buying assets, that's increasing the monetary base, specifically reserves. So how does that feed into interest rates? I'm going to give you two windows into how that works. One is going to be using our broadest view of how it is that financial markets work. Our broadest view of how financial markets work is, of course, the loanable funds market. And why is that our broadest view? It's because in reality, we know there are all sorts of lending contracts. There are shares, there are bonds, there are loans, there are derivatives, and here we're ignoring all that whole zoo of possible different types of contracts, just saying, well, all those are different nooks and crannies of the loanable funds market. Let's just think of the whole thing as one. And of course, the cost of borrowing $1 in this market is the interest rate. The reward for lending $1 in this market is the interest rate. And I'm going to spell out something that I didn't emphasize before, but the text points this out, which is, remember when you borrow $1, I'll actually get back to this in 5 minutes, you're paying back. Let's say you borrow dollars at an interest rate of 10%. Let's say I borrow $100,000 from you, and I pay you back $110,000. In terms of dollars, I'm paying you back an extra 10%. But ultimately, that's not what you care about, and it's not what really affects you, because to you, $1 is not something that you eat. It's something that you use to get things that you eat or otherwise use. And so the real cost of borrowing, the real benefit of lending, is the interest rate adjusted for inflation, which is the real interest rate. So you'll notice if you look at the text, whenever it says something about the loanable funds market, they actually do make a point of pointing out that, spelling out that this is the real interest rate. The distinction doesn't always matter, but sometimes it does. It will in a few minutes. So in this loanable funds market, there's a demand, which is all the investment projects plus any consumption that was funded out of, well, that might be funded out of borrowing. And then there's the supply, and you'll remember the supply of funds to this market involves two things. One, for someone to be able to borrow money, there must be someone else who has money who isn't using it. In other words, someone who is saving. So the first time I discussed this, I said, well, this is basically saving. But just for someone to save, it doesn't mean that they're necessarily giving money to someone else, because you could save by sticking money under your mattress. So in order for these savings to actually reach the market for loanable funds, you have to save them by putting them in some kind of financial asset or in some kind of bank account. And then the banks, of course, then play a role in transmitting those funds to the borrowers. So this supply of loanable funds market involves the funds that the banks have combined with the funds' willingness or ability to supply them here to a borrower. And so when the Fed buys securities and increases reserves, what's it doing? It's actually giving more funds to the banks for them to lend on. In other words, it's increasing the supply. And of course, if it increases that supply, what is it doing? It's lowering the interest rate. Okay, so this is one, I guess, bird's eye view of how it is that the Fed might affect interest rates. There's a second, narrower picture of how it is that the Fed affects interest rates, which we did discuss, but I'm just going to review it quickly. And that was, bless you, reminding ourselves that when the Fed buys and sells securities, very often what it's doing is buying and selling securities in a particular corner of this market. And the particular corner of this market is the interbank market for reserves. And here the price of reserves is the price of borrowing $1 from a bank in the interbank market, which of course is the federal funds rate. And here, the banks have some demand for reserves based on their liquidity needs, based on whether or not they're bank runs, based on, well, the state of their balance sheets. But the key idea here is that the supply of reserves is entirely determined by the Fed. How is it determined by the Fed? Well, by its open market operations, by how many assets they've bought. They can choose exactly what the reserves are by, well, choosing how much to buy or sell of assets. And what does that mean? That means that the Fed can control essentially the cost of funding for the banks. If it knows where the demand curve is, it can just change the supply of reserves by, in this case, buying assets, to choose whatever their preferred Fed funds rate is. And of course, this is the Fed changing the the interest rate banks charge each other, which might seem like a distant step from the interest rates you or me pays, because we aren't banks. But of course, if the cost of funds is, in this case, lowered for all the banks, that enables them to lower all the interest rates that they charge us as well. In fact, the banks compete. So as soon as the Fed funds rate does something, all the other interest rates are going to go down with it. Or conversely, if the Fed funds rate rises, banks can't profitably lend at the same interest rate as before, so they have to raise rates too. So we have this broader intuition about how the Fed might affect interest rates, and then this more narrow one focusing on how the Fed is directly trying to affect the cost of funds to banks. But of course, that then is spread to other interest rates. Okay? Any questions, comments, or thoughts about this traditional interest rate channel effect? All right. So that all has to do with new lending contracts, right? This is the cost of new borrowing the Fed is impacting in this fashion. However, if you think about it, new borrowing might be a small amount compared to all borrowing. What I mean by that? There's new loan contracts that you and I are agreeing, and when the Fed buys large amounts of securities, it lowers the interest rates on those new contracts. But then there are all sorts of outstanding debt contracts. For example, I have, how much do I have? I think about $600,000 in outstanding mortgage debt at a 30-year fixed rate mortgage that I have to pay off every month. And of course, it's a fixed rate mortgage, so the Fed can do this, that's not affecting my interest rate. So what if the Fed could do something that actually does affect those contracts that remain outstanding as opposed to the new ones? That might potentially be a bigger influence on consumption and maybe investment by lowering the burden of that debt. So here's another one. To see this other interest rate effect, let's go back to this discussion we just had about why ultimately what you and I care about when we borrow isn't the nominal interest rate, it's the real interest rate. So let's remind ourselves that the nominal interest rate is, remember we had this example there, you lent me $100,000, I promised to pay you back 110 next year, so the nominal interest rate is 10% because I'm giving you 10% more dollars, but what you ultimately care about would not just be the amount of extra dollars I'm giving you, but how much those are worth in terms of goods and services. And of course, to the extent that there was any inflation between you giving me $100,000 and me paying you back $110,000, those dollars aren't worth as much as the ones you gave me. So ultimately you care about the real interest rate, which is the nominal interest rate minus any inflation over the period of the contract. Now suppose the Fed lowers rates in the way that we described. What does it do here to the contracts that were already outstanding, such as my 30-year mortgage? Well, let's draw our macroeconomy. The way I'm drawing it, we are in a recessionary gap. Of course, I'm starting there because the premise is that the Fed is trying to stimulate spending for some reason, and we must be in a recessionary gap. What the Fed's doing by lowering rates is it's trying to push the demand curve back towards long run. And of course, one of the things that does is raise the price level over what it would have been, right? In other words, what the Fed is doing is raising that. So my outstanding 30-year fixed rate mortgage, fixed nominal rate, right, suddenly ends up being less burdensome for me in real terms, because the Fed has raised the price level above what it would have been, which lowers the real burden of that debt on my finances. And of course, if something lowers the real burden of debt on my finances, it frees up more funds for me to go and buy stuff. So the traditional interest rate effect is this one, it just makes borrowing cheaper. But there's this indirect effect, which is that by raising prices over they would supporting prices from, I guess, falling further, you're raising inflation over what it would have been, which lowers the real burden of debt. Okay? Yes?
For example, if you have a mortgage, inflation is inflated.
If inflation is what, sorry?
So if you have a mortgage, there's an inflation that's inflated.
There is a broader lesson here, yes, which you are seeing, which is that, okay, so if you and I were negotiating a new loan contract, the fact that inflation means that if you're the lender, the fact that inflation is bad for you means that if you and I were negotiating, you'd probably demand a higher nominal rate if we expect high inflation, right? But if you and I already agreed that inflation ends up being more than we anticipated, then I, the borrower, would be delighted, and you, the lender, would not be happy, right? And that's going to be generally true, whoever the borrower is and whoever the lender is. Now, you might say, well, doesn't that undermine this because, okay, the borrowers have more funds, but the lenders don't? Well, the lenders were lenders, so they probably didn't have any imminent spending plans anyway. So on balance, it would still go in the direction of stimulating more spending. But this idea that unexpected inflation benefits borrowers is important in other ways. So it's a good observation that you made. In particular, what entity is the largest borrower in United States financial markets? Yeah, the federal government, of course. So, using this logic, what would the federal government like in order to make its debt more manageable? Surprise inflation. Surprise inflation lowers the real value of its debt, the real burden of its debt. So remember we were discussing on Monday the potential importance of central bank independence. Here's another reason. If the government could control the Fed, they have this incentive to try and give us surprise bursts of inflation in order to get rid of the burden of the debt. All stemming from this broader notion that surprise inflation is good for borrowers and bad for lenders in real terms. All right. Any further questions, comments about inflation, expected or unexpected? Okay. So there is a third interest rate effect, and this relates to something that you would spend a lot more time on if you were to take any of our international economics courses. So, how many of you are in the Elliott School? Okay. I expected more, but anyway, so maybe a third of the class. And so at some point you'll have to take 2180 or 2181 and 2182. And in those classes, of course, since they're about international economics, a lot of the classes are about international trade, determination of exchange rates, and other things to do with international economics. And we haven't spent too much time on that, and part of the reason is because much of our discussion of macroeconomics has revolved around US data. And the United States is actually, even though, of course, the United States trades a lot with other countries, it's far less dependent on international trade than many other economies are. So what I'm about to say is going to be most relevant to other economies. But suppose the interest rate goes down as discussed because the Fed is trying to stimulate the economy. What does that do to international markets? In particular, what does that do to the value of the US currency? Well, we talked about currency values, and we started off by talking about one theory of currency valuation, which was purchasing power parity. And that was all driven by the idea that the reason anyone would want to buy currencies from other countries is because they're trying to buy ultimately goods and services from those countries. That's how we came up with purchasing power parity. But then we observed that it doesn't actually work too well as a theory of currency values. Well, it works, but it takes time or only works in extreme situations. And so there must be something else going on determining currency values. And of course, the answer was that the vast majority of foreign exchange transactions aren't because someone's trying to buy foreign goods and services. Rather, it's because someone's trying to buy foreign shares or foreign bonds, foreign assets of one kind or another. And of course, if someone is trying to buy US dollars because they're trying to buy, let's say, US bonds, what are they going to get? They're going to get the interest. At least the interest rate on US bonds is going to be one part of what an international investor is going to get if they decide to buy US assets. And here we're sitting in a situation where the Fed is cutting the interest rates. So what does that do to the attractiveness of buying US assets? Goes down. They're not paying as much interest as they were before because of what the Fed's doing. And if US assets are becoming less attractive, that means demand for the US dollar decreases, which of course intuitively means that the value of the US dollar should go down. What does that have to do with spending? Well, if the US dollar is cheaper, what does that do to the price of US goods on international markets? They've gone down. US goods are now cheaper. Moreover, foreign goods look more expensive to us here. So exports up, imports down. More net exports. So these steps required us to link, I guess, what we discussed about, well, to link our notion of how the Fed can affect interest rates together with our earlier discussion about how currencies are determined, which again isn't central to this class. It's something that we talked about, but we didn't spend a lot of time focusing on it. Nonetheless, for countries which are very open to trade, which depend heavily on imports and exports of different things, this is actually really important. Okay. So we have a graduate student who recently wrote a research paper, well, it's his dissertation, I guess, on, well, on the subject of how various developing economies determine what their interest rates are going to be. And a fun part of his study was that not only did he do various statistical and econometric procedures to try and answer his question about how central banks around the world choose their interest rates, he actually also interviewed something like 100 different central bankers to see what they had to say, to see if there was anything systematic about what they were saying that would sort of support his statistical work, just sort of more traditional economics research style. And a lot of their answers revolve heavily around this. The idea that, let's say, for example, suppose the United States raises interest rates. Well, that would be the opposite of this, right? Then suddenly funds would be going to the US to try and get those extra returns. And most of these central bankers would say, well, if the Fed raises interest rates, that forces us to raise rates to make sure this doesn't happen, right? But suddenly our rates are low compared to the US, so so no one wants to buy our goods and services anymore. So as I said, this actually is very important. Not so much for the US, but for everybody else. So important that very often when the United States does something with its interest rates, other countries feel compelled to match it to avoid any major impact on their trade and capital flows. All right? Any questions, comments, thoughts? Okay, so much for interest rate effects. As I mentioned, however, there are several categories of ways in which the Fed can affect spending. And so there is an entire second category that I'm going to refer to as wealth effects. So 4. Care to share what's so amusing? All right. So wealth effects. Suppose the Fed is lowering interest rates. Here we've been focusing, I guess, largely on, well, I guess this is some combination of household spending and business spending. Right? But now I want to focus on the businesses. If you're lowering interest rates, thus making the burden of debt lighter for borrowers, that means that, of course, the borrowers are generating relatively more profits than they would have been. And indeed, they're likely to continue generating better profits than they would have been for some time, for however long the Fed's action lasts. And of course, that benefits whoever it is who owns those companies. So what index or measure do we have out there that tells us something about how profitable companies are and how profitable they're likely to be in the future? Share prices. Remember that it's been a while, but back when we discussed different kinds of securities, we discussed that among the various kinds of securities that there are, we have shares, and what are shares? They're the entitlement to a piece of the profits of whatever company's shares you bought. And of course, the value of a share, we discussed this, a value of a share of, let's say, Microsoft is based on how profitable is Microsoft right now, and most importantly, how profitable is it likely to be in the future? And of course, if you make it cheaper for Microsoft to borrow, what are you doing? You're lowering its costs, which means you're increasing its profits now and in the future, which means you're raising its share prices. And, of course, shares are one of the many different ways in which you and I might store our wealth. So, not everyone, I guess, owns shares, but a lot of people do. And the people who own shares, even if it's a small number of people, they're responsible for a lot of spending. And so more wealth, as we've discussed, means more consumption. So indirectly, the Fed cutting rates, trying to stimulate spending, should raise share prices and thus boosting wealth and increasing consumption over what it would have been otherwise. And it may seem abstract that an increase in share prices might lead to an increase in consumption, but there was a very real and clear case of this some years ago. So for this, we'd have to go back to the late 1990s. So you probably weren't there, but anyway, I'll tell you about it. So in the late 1990s, the United States stock market was just shooting up. And the reason it was shooting up was that there was this idea that there was a new economy. So there are all these new companies like Amazon that were startups. They were fairly small, but there was this view that, first of all, these companies were going to transform the way the economy worked. And second, they were going to be very dominant in the future. Right? Let's say, for example, Amazon started out as a bookstore, but they were taking on more and more lines of business, and the expectation was they might sort of become a dominant force in retail overall. Were they wrong? No, that happened. They were wrong about some things, though, because some of the early companies that seemed like they might be big players in the future didn't make it. Amazon made it. Not all of them did. Ever heard of Cosmo.com? Exactly. They didn't make it. But for a while, they were thought of as being the next thing. So they were taking Amazon's model to the extreme where you could sort of order, let's say, your favorite book plus a burger plus a bottle of wine, and they deliver it within 20 minutes. Right? That business model failed. But at the time, it wasn't clear. Would it fail or would it succeed? Anyway, so because a bunch of these early movers started failing, of course, what happened is that eventually the stock market went down because there were some winners and there were some losers. Which is not unusual. Then whenever there's any sort of new business model or new product, there's usually a bunch of companies that are competing to be the dominant force. It's unclear at first who's going to win. The business expands, and then there's a shakeout where a whole bunch of them collapse and then sort of becomes a mature industry. And so this was happening at the sort of national level because the retail industry is just colossal, right? Everything has to go through there. And so share prices were so high that there's this thing in chapter 11 which I didn't emphasize, but you may have looked at it, called the marginal propensity to consume, which is more or less, given that you have $1 in income, how much of it are you going to consume as opposed to saving? So the marginal propensity to consume in that period, when the stock market was sky high, was more than 1. Because people were spending more than they were earning, more than their disposable income. You say, how could this be? And the answer is because share prices were through the roof. And people expected them to stay there. They were wrong. But again, for a while, share prices were supporting a huge amount of consumption. until the bubble popped. And then, well, I guess it's history now. Of course, not everyone owns shares. Yes?
Interest rates are just one factor that influences like share prices.
Of course, right. The quality of your business plans are presumably, hopefully more important. But remember 2000, March and April of 2000, I said the wrong number. Remember April and March of 2020, that's what I was trying to say. You were there, right? So I remember at some point I would look at the Dow Jones Industrial Average Stock Market Index and how it just spiraled downward because, of course, we stopped buying cruises, we stopped going to restaurants, we stopped doing all sorts, we stopped hanging out at malls, and so spending collapsed and share prices collapsed. What did the Fed do? They did everything imaginable. They lowered rates to zero, they started being lenders of last resort, they did other things that we'll get to in a few minutes unless we run out of time, which is a real danger, actually. What happened to the stock market? It soared. So 10% of the workforce was out of work. And obviously it's an economic disaster, but the stock market was just soaring because they didn't just lower rates, they lowered them to zero again. So no, of course, there are many things that are behind the stock price. Stock prices. The interest rate is only one of them, but it does matter. Yeah. I mean, over 2021, which again you would think of should be a time of economic difficulty, I managed my parents' financial portfolio. They earned like 20% returns over that year. It was ridiculous. And then they lost them later. But yeah. That's just the way it is. So, as I was saying, not everyone owns shares. What is the largest asset that most families have? Their house. You said mortgage, which is the loan you need to buy the house, but yes, it's the house. And what happens when interest rates go down? Well, you're right. Most people don't buy houses with cash. Most people buy houses with a mortgage because, of course, if let's imagine the average house costs, let's say, $700,000, most people don't have $700,000 lying around. You have to borrow a mortgage. If you lower interest rates, what are you doing? You're making mortgages cheaper. So you're increasing demand for housing. Of course, if you increase demand for housing, what are you doing? You're making house prices go up. And while share prices matter, I guess, mainly for a relatively small group of fairly wealthy people, although that small group of wealthy people does demand a lot of goods and services, house prices are going to have a sort of broader impact on people's wealth. And of course, it's not the case that you can... The idea here isn't that your house price rises, so you're more likely to sell your house and use the cash to buy something. What happens is that there's something called a home equity line of credit that means you can borrow against the value of your house and use it for spending. And whether it's on renovating the house itself or whether it's on cruises or who knows, it doesn't matter. Actually, a lot of, retired people make use of home equity lines of credit. Precisely in the way I described. Oh, my house price is worth more, so that means I can take out an equity line of credit, borrow against the house, and let's go on a cruise together. So that stimulates spending as well, right? And then there's one more wealth effect. Okay, someone's phoning me. They can go to voicemail. Or to hell. I don't know. I don't really care either way. So There's one more wealth effect that I should probably tell you about, which is kind of abstract, but it's something that you may come across if you take financial economics or if you're in the business school. How many of you are in the business school? More than I expected. More than in the Elliott School. Interesting. Okay, practical people. So there is something called Tobin's Q, which is defined as the following. It's a ratio. On the top, for any given company, is the value of the shares. I'm going to write share value. And what underpins the value of a company? Well, there's two things that a company has. One is it has a bunch of capital, right? Machinery, buildings, tables, computers that it owns. And it also has, of course, the quality of its business plan and so on. So all of that comes into affect the share value. On the bottom here, however, I'm going to write this, the replacement cost of the capital that this firm owns. And why would this ratio be of interest to economists or to people in business school? Well, if you're owning shares, you're someone who has a lot of money and is looking for productive ways, profitable ways of investing it. And one thing you can do with your wealth is to buy shares, in which case, what are you doing? You're investing in someone else's pre-existing business. But what's the alternative? The alternative, of course, is to start your own business. And if you start your own business, what do you need to do? You would need to, instead of buying up a pre-existing business or sharing it, you would be building it from scratch, in which case this is the cost of what you would have to incur to get that thing going. So when interest rates go down, which raises share prices, what are you doing? You're making it more expensive to invest in a pre-existing concern, which makes it more likely that you would start your own instead. In other words, lower interest rates raise Tobin's Q, and when Tobin's Q goes up, that means it's more costly to give my money to someone else as opposed to using it to start my own business. So investment goes up. Okay. It's a bit abstract, but if you think about it, if you think about the position of whoever it is who actually has all this money, there's always this trade-off between buying someone else's shares versus doing your own thing. And doing your own thing is a more attractive option when interest rates are low. Okay. Any questions, comments, thoughts about this? Let's see, how are we doing for time? We have 26 minutes. I think we'll make it. So much for wealth effects. The last set of effects I want to talk about, is it last? Well, I guess it depends on how long it takes. The next set of effects I want to talk about is, I guess, what we could call credit effects. These are, I think, easier to talk about and think about. So, to think about these, remember that the first day we talked about the Fed, I introduced the Fed as the lender of last resort. Remember that? So when there's a situation where maybe all banks want to shore up their reserves at once, which means they're all trying to borrow reserves at once, as opposed to the normal situation where some are borrowing, some are lending, then the Fed may step in as a, quote, lender of last resort to supply all these reserves that the banks want. So one way it could do that is by making discount loans to them, right? Just lend them all the reserves they need and let them pay back when they can. And of course, going back to what I wrote here initially, discount loans up directly is raising the reserves of the banks. And as we were discussing, more reserves increases the funds that the banks can then lend out to everyone. So what it's doing ultimately is making more credit available, and that, again, raises consumption and investing. What's the difference between this and the interest rate channels? The interest rate channels are about making credit cheaper. This isn't about making it cheaper, it's about making more of it available. That's the difference. And this kind of credit effect has been receiving a lot more attention lately, and of course the reason why is because, well, it's because of 2008. That's exactly what the Fed did when there was a financial crisis. What did the Fed do? It provided massive amounts of reserves to the financial system. The difference was that when the Fed did that in 2008, it didn't do so by discount loans. It did so by buying colossal amounts of bonds in exchange for extra reserves. And you'll remember the name for that kind of action is quantitative easing. So that's the exact same thing as making massive amounts of discount loans. It's just that the way you're doing it is by buying massive amounts of assets. The way the Fed is doing it is by buying massive amounts of assets. But it's the same thing otherwise. The idea is that you're just making more credit available. Now, there's one more thing I want to mention here under credit effects. And it's subtle, but it's also central to how financial economists look at the world and look at monetary policy these days. And if we ever meet again in Econ 2121 Financial Economics, we'll spend a long time talking about this. And how should I summarize this? So the idea, I guess, is the following. Suppose that, consider a bank's day-to-day business. A bank's day-to-day business is to have people like you and me come in and say that we want a loan to pursue some venture, and then they evaluate the quality of our of our plan, and then decide whether or not to lend to us. That's what they do. Now imagine the bank trying to do that in, let's say, a situation where, okay, let's just go concrete. Now imagine a bank trying to do the same thing in 2008. So what's going on? First, their bank runs. So the bank is going to be much pickier about who they lend to, right? Because they want to hold on to their reserves and only want to give them up if there's a really good reason. They want to stave off bank runs. Second, given that, you'll recall there were all sorts of problems, house prices were dropping, so people's wealth was going down, and a lot of people were unemployed. So if the bank is evaluating you, given that now that we're in a situation where a lot of people are in financial difficulty, they may feel that if I'm applying for a loan, I'm not actually telling them everything about me. Or indeed, I may not even realize that I'm at risk of losing my job or losing my house and so on. In other words, there's suddenly a situation where you know a lot less about who you might be lending to, and it matters. It matters because, again, the risks are much greater in that situation. So then you might be a lot pickier about who you lend to. And then if the Fed shores up the economy by lowering interest rates through all these other channels, one of the things it's doing is it's lowering the risk that, lowering the difference between people who are good lending prospects and the rest. I'm trying to think of a good term for summarizing this. I could just call it willingness to lend. How about that? What happens is that if you were to take my financial economics class, I would talk to you extensively about a concept in financial economics called adverse selection. And the idea there is that you have two kinds of something. Imagine you have two kinds of, sticking with this example, imagine there are two kinds of borrowers. One is a good prospect and one is a bad prospect. Imagine you can't really tell the difference between them. If the difference between good and bad is not that big, then maybe you wouldn't care, right? But imagine the difference between good and bad is very big. Then you'd want to lend to the good one, but you wouldn't want to lend to the bad one. But you can't tell them apart, so the terms you're going to offer are going to be somewhere in between. Which means the good one isn't going to show up because they're never going to be able to get what they deserve, which means you only get the bad one. Or put it another way, imagine actually the common example for describing adverse selection is the used car industry. So suppose you go to buy a second-hand car, and you know there are good cars and bad cars, but the buyers can't tell the difference. But the dealer can. So the dealer will take what's the dealer's incentive? Actually, have you seen Matilda? Or read Matilda? Her dad is a used car dealer, and what does he do? He takes bad cars, makes them look good, sells them for the price of a good car, and then of course they break down. So this is the perfect example of adverse selection. The good car, what's he going to do if he has a verifiable good car? He's going to keep it. So the only ones that you observe traded are the bad ones. So this adverse selection idea is what I'm going for. So in bad economic times, especially in financial crisis times, adverse selection is a big problem. And so that means that banks are going to be much less willing to lend because it's hard for them to tell if the person they're lending to is then going to go bankrupt soon. But in good times where this is not such a big concern, they're more willing to extend credit. And so I'm going to write adverse selection here in case you are interested in looking further. All right, any questions or thoughts about that? There is one last class. Do I have time? Yeah, we're good. So D. And this has to do with what we've been spending the last week talking about. And that is to do with expectations. And there are two ways in which expectations matter for the ability of the Fed to influence macroeconomic outcomes. One we spent most of our time discussing, and that is this idea that a key asset of the Fed in trying to implement its policy is what I broadly called credibility, right? The impact of what the Fed does can be very different depending on whether we trust the Fed or not. So we discussed this in the context, mainly in the context of the Fed trying to fight inflation. That if the Fed is trying to fight inflation and we believe that they're going to do a good job, then our inflationary expectations don't change, and that actually helps the Fed. But if the Fed did the exact same thing in a situation where we don't trust them, then it wouldn't work. So credibility is one thing that I need to put on the board. But there is actually one more that I think is worth mentioning because it played a key role in the recovery from the financial crisis. And that is that, and actually this still happens today. When the Fed announces its monetary policy, let's say we are going to lower interest rates by 0.25%, they don't just say what they're doing, and this is actually fairly new. It started about 20 years ago. New in the sense of the history of the Fed. 20 years is a while, but the Fed had a long history before that, where they never did this. What is this? This is what's called forward guidance. In other words, when the Fed announces what it's doing, it also announces what it plans to do going forward. This was particularly obvious in the aftermath of the Great Recession, the financial crisis of 2008, because the Fed would say, we are going to hold interest rates at 0, and we will continue to do so for the next year or two. So they were telling you not just what am I doing now, but what am I planning to do for the foreseeable future. And of course, it's one thing to know that interest rates are low, which might have all the effects we described, but it's another to know not only are interest rates low now, but again, if I believe the Fed, and the Fed is telling me interest rates will be 0 for the next 2 years, that means I can plan accordingly. That means my borrowing costs aren't just low now, they will be low for 2 years. So I will may spend more now because the interest rates are low, but I may also spend more now because I know they'll stay low. So that's the idea behind forward guidance. It's very interesting, actually, before the Fed started doing this, the Fed felt compelled to do the exact opposite, that they would make an announcement about what interest rates were going to be, and then be completely unclear about what their plans were going forward because they were afraid that anything they said might make markets move too far. If they thought that the Fed was saying, we're going to do this and then maybe we'll raise rates more, they were afraid markets might jump like crazy in response to misinterpreting what they were saying. I guess the idea of forward guidance is the opposite. It's like we want to use people's expectations precisely to try and have a bigger impact today. Yes, sorry.
If interest rates are like known to be low, doesn't that discourage lenders to lend money?
Discourage lenders. Well, remember, I guess sort of, because it's not really rewarding, but remember at that time, what's the Fed doing? It's really pushing, it's supporting the lending because it's behind it, right? It's, in the case of discount loans, lending directly. In the case of quantitative easing, it's lending indirectly by buying tons of assets. So it's still, so it's fighting against that. But yeah, I guess that feeds back into this discussion we had a while ago of if interest rates are really low for a really long time, it means you're kind of supporting relatively unprofitable business ventures, which in the long run might actually slow the economy. But, well, that's a concern some economists have. All right, any questions or comments? In that case, time for the exit quiz. First question. True or false? Monetary policy works in only one way. This should be an easy one. Of course, it's false. Next. One way monetary policy stimulates the economy is by which of these? Of course, the answer is red. Lowering interest rates, which increases investments, among other things. Another way monetary policy stimulates the economy is by Of course, the answer is lowering interest rates, which increases net exports by making the US dollar cheaper. What is an example of a wealth effect of monetary policy? Of course, lower rates raise share prices. What is another example of a wealth effect of monetary policy? Of course, lower rates raise housing prices. This is a poll. Which do you think are the more important kinds of monetary policy channels? Just out of curiosity. Now that you've looked at all of them, and of course, let's see. Interest rate channels. Interesting. Last of all, what is Tobin's queue? Is it the line of people outside Tobin's Pizza, which is in Bloomington, Indiana, or one of these other things? Let's see. Share price divided by the cost of capital. All right. Let's see how we did. Third is it is what it is. Second is the. And first is Noah. All right, Noah, good job. I have a little something for you if you wish. Otherwise, nice to see everyone. Have a good weekend. Look forward to seeing you on Monday. Take care.